Tech stocks are getting crushed again. But that's exactly when smart investors get interested. While others panic, we look at the data. And the data says Google, Meta, and AMZN are now trading at attractive valuations relative to their fundamentals. In this video, we'll show you why these three giants still have massive upside, how they stack up on valuation metrics, and how we'd split $10,000 between them today using our favorite investing method, the discounted cash flow model. And don't worry if the market keeps falling. We're in this for the long game. Smash that like button if you're focused on building wealth the smart way. And subscribe for weekly deep dives on stocks that are undervalued, not overhyped. Let's start with Alphabet. Google. Google dominates global search, YouTube is a beast, and their cloud business keeps growing. The stock is trading at a forward PE of just 20, compared to its historical average of around 23 to 25. Our discounted cash flow model shows a fair value of $195, while the stock trades around $155. That's a 25% upside. And you're not even paying a premium for all the AI integration they're rolling out. Free cash flow, over $76 billion trailing 12 months. Google is lean, dominant, and on sale. Next, Meta Platforms. Yes, they've been through some storms, but guess what? They cut costs, streamlined operations, and now generate $54 billion in free cash flow. Based on our DCF model, assuming 10% growth, a 10% discount rate, and 5% terminal growth, Meta's intrinsic value comes out to $587 per share, while the market has it at around $485. That's a 21% upside, and the market isn't even fully pricing in the metaverse optionality anymore. Even on a valuation basis, PE is 27, forward PE is 22, both well below historical norms, which hovered above 30 pre-2022. And finally, Amazon. While the media keeps hammering it for thin margins, here's the truth. Free cash flow is roaring back, e-commerce is stabilizing, and AWS is still the backbone of the internet. With a price-to-earnings ratio of 32.48, a forward price-to-earnings of 27.93, and a price-to-sales of just 3.02, Amazon is no longer expensive by historical standards. The company pulled in over $38 billion in free cash flow in 2024, and if that continues to climb, we estimate the fair value at around $161, while the stock trades at $118. That's a 36% upside and honestly, a classic case of a temporarily misunderstood giant. Let's pause for a second to look at the bigger picture. Here's how the numbers stack up across these three stocks. Amazon has a price-to-earnings ratio of 32, with a forward price-to-earnings of 28. That's slightly above average, but it's improving. Meta's price-to-earnings is 27, and its forward price-to-earnings is 22, well below its usual 30-plus range. And Google, its forward price-to-earnings is 20, cheaper than normal, even as its dominance keeps growing. When companies this strong are trading below their historical multiples, that's not just random, it's an opportunity. Now, will prices fall more? Maybe. But the truth is, nobody can time the bottom. What we can do is act when great businesses are selling for less than they're worth. That's what long-term investing is about. Not reacting to headlines, but trusting the math. So, if we had $10,000 to deploy right now, here's how we do it. $4,000 into Google. Great cash flow, growing artificial intelligence moat. $3,500 into Meta, deeply undervalued with operational strength. $2,500 into Amazon, high upside back in growth mode. This split balances stability, upside, and strong fundamentals. Look, markets are messy, but great companies don't stay cheap forever. The time to act is before the next bull run starts, not after. We've done the math, now it's your turn to decide. Full disclosure, I don't own any of stocks here except writing a few put options on them at strike prices close to current prices. Go ahead and grab our free discounted cash flow Google sheet and summary tables in the description below to run your own numbers. Like this video if you believe in long-term wealth building, subscribe for more deep dives every week, and check out this next video on how to value any stock using our discounted cash flow method. It's linked right here on screen.